Casey with Hanghold Capital Management. And Casey, we talk a lot about the market, the stock market. We talk less about bonds over time. And it's something I guess maybe a lot of people don't know as much about. So a crash course on bonds. Hit us.
Well, first of all, understand the difference between the two. A stock, you're an owner in a company. I think most people understand that. And you're sharing in the profits and losses of the company. With bonds, though, you're not an owner. You're a loaner. You're loaning money to a company, and in return, the company is going to pay you a rate of interest.
So to a degree, it's kind of like a CD where you're in effect loaning money to a bank.
That's right. So a lot of people understand that concept. You give money to the bank, and let's say with a bond, you're usually loaning money in $1,000 increments, and they pay you a rate of interest, and they usually do that semi-annually, and the bond has a maturity date, and at that time, the company pays you back $1,000. Now, what's challenging for people, I think, when they buy a bond is they don't always understand the return they're going to receive because the bond itself they may see is going to be paying 6%. They'll see the stated rate of interest. But if you pay a premium for it, keep in mind in the future when that bond matures, you're going to get $1,000 back. So the way you calculate your interest rate is you look for the words yield to maturity. That tells you at the time you make the purchase what is going to be the rate of return on an annualized basis I'm going to receive on this bond investment.
All right. And then different types of bonds that are available. They would include what?
You've got U.S. government bonds that are considered the safest, down to different levels of foreign governments, to levels of corporate bonds, municipal bonds. These are tax-free bonds or for the public good. And so the longer a period of time, like a CD, the longer a period of time you're willing to lend money, typically the higher rate of interest you're going to receive, as well as the credit rating. The higher the risk that you're willing to take on, the higher the interest rate that you're going to be paid. Now, the reason you invest in bonds, though, keep in mind it's for cash flow. It's for the rate of interest they pay, but bonds provide stability to your portfolio, and they tend to not correlate closely to the stock market.